It's not what you make, it's what you keep. And in this video, I want to be going over several of the tax strategies that I've learned after several very expensive consultations with tax strategists, tax lawyers, tax professionals, tax this, tax that. And I've learned a lot of things that I had no idea about before that I believe can massively alleviate the tax burden that many people experience at all levels, really. But of course, it does work best at a certain level, which we'll be going over. And I'll also explain to you how, the average person can also make that work for them as well, because all of these can effectively be used in some form. And I also want to say that these are strategies that I had no idea about. And I went to college. I went to University of Oregon. I studied business. I studied economics. I didn't learn really much about this. I even had a course in taxes. None of it went over actual tax optimization and tax strategies. So this is the real value of consulting with someone who is a real tax strategist, because other than that, most of the time these guys are just punching in numbers, and realistically, you could probably do a lot of this work yourself, to be fair. But if you actually know these strategies, you can really start to maximize how much money you're actually keeping, and then you can use that money that you're keeping to compound in wealth building vehicles. Now, I want to say at the very outset here, I am not a tax professional in any way, shape, or form. I've just spent a lot of money consulting with these people, but please consult a real professional to get direct and personalized help. I am not that person. Hopefully this can be an inspiration that you can use to badger your current accountant or fire them, which is what I did, and get someone who actually does know what the fuck they're doing. On top of that, this is going to pertain mostly to US tax law. Now, many Western countries are very similar in this regard, but of course, I'm a US citizen, so I am going to be focusing on this from a US centric point of view. But yeah, most Western countries pretty damn similar. There might be some things that don't necessarily match, but ultimately the US is actually a great place with a lot of tax advantages if you understand the system. So let's get into the next slide here. And I want to give an example of two investors, both of them making $1 million in 1 year. They make it in the markets. One ends up keeping about $700,000. So not terrible, but 700,000. So you lose about 300,000 to the good old US government. The other keeps closer to about 950,000. Same returns, same markets, but a massive gap in what they walk away with. The difference isn't luck or even skill, it's tax strategy. And this is the crux of this whole presentation. It's all about your strategy. These things need to be laid out in advance. And they're honestly, most of them are very easy to do. Realistically, most things in the US are really just hidden by like a couple layers of complicated language and a lot of text under the laws and all of this. But if you just peer a little bit over that wall, if you just peer a little bit over it and spend, even just a week or two of studying these sort of things, it's really not that difficult. Most of these things are, again, and can be set up very quickly. So like I said, the following info is everything I wish I knew much earlier and would have ultimately increased my wealth significantly. I mean, shit, man, like it honestly drives me nuts thinking about this stuff. So hopefully these strategies that I can impart to you, you can use and compound your own self better at an earlier age than myself. Because honestly, it's best to know this stuff as soon as possible, because the earlier that you learn it, the more that you get to keep, the more that you are able to compound, and that can grow, significantly over time. I mean, shit, man, if I knew this even 5 to 10 years ago, I would have probably rolled my wealth maybe 10x what it is right now. And that would have been very, very nice. Anyways, let's talk first about the purposes of tax advantages, just because I think if you understand the underlying logic for these things, it'll make a lot of sense into one, how you are supposed to employ these things, and then two, I think it can kind of get around the general criticisms that I typically hear about taking tax advantages. It's like, oh, this is the wealthy just taking advantage of the system and playing it in a dirty way. No, nothing that we speak about here are loopholes. These are all very, very specific laws that the US government has made to give people tax advantages as incentives to effectively do what the US government, wants you to do. They're trying to guide capital and behavior towards areas that stimulate growth and benefit society. So that is a really key point. legally lowering your taxes, which is all we're going to talk about here. We're not talking about anything illegal. Look, if you're doing something illegal, like good fucking luck with that. I hope you can try to sleep at night because, well, honestly, I don't, because I do not think that anyone should be trying to cheat the system. Legally lowering your taxes, however, isn't just lawful. In my opinion, it is both moral and efficient. You're directing money towards things the government wants you to do rather than handing it over to, government bureaucrats to decide what they want to do with it, which is going to be inherently inefficient. As we all know, the government is not the greatest allocator of capital, and that is one of the major issues with bigger governments and other systems of government. But I'll save that maybe for another video. Or actually, that's not even a topic for this channel. But what I want to say is that yes, if you have an issue with giving money to the government because you don't like what they do, well, guess what? You can actually make decisions for yourself that would reduce your tax burden, and you get to put the money where you want. That's the beautiful thing about it. I mean, put the money where you want within the bounds of the law, obviously. You can't just spend it on hookers and blow and be like, hey, but I put it where I want. You are stimulating the economy in a way, yes, but maybe some illegal activities in there. So again, put another way, every dollar that you save and reinvest in it is a dollar creating more growth, jobs, housing, or innovation. And that's better for you and for the wider economy. So you're not just helping yourself, you're helping the wider economy. And this goes back to one of just my personal philosophies that selfish altruism is an important thing. You want to do what's best for yourself. That's also best for the greater whole. When these two things correlate, when these two things overlap, we have a beautiful, beautiful compounding effect. And that is really, I mean, that's as good as it gets as far as I'm concerned. We will also revisit this notion at the end of this presentation and connect the dots as to how this precisely works with the strategies mentioned. Basically, how you are, promoting growth in the wider economy. Okay, now I really debated with myself if I wanted to include this slide or not. I really want to say at the outset, please don't hate me for what I'm about to state. I am not in any way, shape, or form saying that certain people are more valuable than other people. I'm not saying that people should not be unequal under the eyes of the law. In my opinion, or in my belief, I believe that everyone should be equal under the eyes of the law. In a court, I think that everyone is equal in terms of, your value as to your potential, but in the context of tax laws and the economy, people at the moment some people are providing more value to the economy than others in terms of what they can create and the sort of growth that they promote. And so the US government is giving typically people who take on more risk, more burden to potentially provide that growth, which typically comes in the form of, investing or business owners, or people just who take on more risk in order to do the job and do the work. The government rewards them by giving them tax incentives, by effectively, lessening the burden of the insane risk that they're taking on. And I want to give you a few stats here if you don't necessarily believe me or subscribe to these beliefs. In the US, your business failure survival rates are about 20% of new businesses that are started every year, just they straight up fail. And in 5 years, about 50% fail. In 10 years, 65% fail. And in 15 years or more, you're talking about 25% of those year ones, those are going to be surviving at that time. Now, I want to be really, really clear in stating this. Those numbers are very generous. One, they're generous because obviously they're rounded up, and the real data is probably a little bit lower. But even worse, just because you're surviving does not mean that you're making money. In fact, most businesses, as you'll look over here on this portion of the slide, do not make money, especially in their first year. According to the SBA and NFIB, only about 40% of small businesses are profitable overall. That's including all of them, not just the first years, but also the year 20s. I'm telling you, it is really fucking difficult. The odds are overwhelmingly against you to start and actually have a profitable business that survives even a year. 30% break even, so not losing money, but not making it. And 30% lose money. So you're in business. You're told by all of these people from a certain walk of life that you're an evil person because you're a business owner, and but at the same time, you're just losing money. You're just losing money. Terrible. For the first year, businesses, about 20 to 25% of businesses are profitable in their first year. So not only do only 20% of businesses, of new businesses fail within the year, 20 to 25% are profitable. So overwhelmingly, they are just not even profitable to begin with. Most of those either break even or lose money while ramping up. By year 5, around 45 to 55% of surviving businesses, most of them already failed, but about half of them are profitable at that point. Now, we're not saying how profitable they are. Maybe they're just a little, even if you just make one more dollar than your cost to operate, your expenses, you are technically profitable. So it doesn't mean that you're like massively swimming in the money or anything like this. And then by year 10, about 60 to 70% report profitability. So that now we're starting to look okay. But again, survivorship bias at that point. Most of those year 1 businesses are long and gone, and who knows what the hell happened to those people? What sort of loans and debt they have from their failed attempt at entrepreneurism. Is that even the word? Anyways, my point is that the reason why you're giving these benefits is not only because, of course, it can help guide capital to areas that the U.S. government wants you to help out, but also because people who are starting new businesses or you're doing something in this way, even if you're a contractor, it's very difficult. It's very, very difficult to be even profitable and survive past a couple of years. I mean, the odds are so overwhelmingly against you that it's kind of crazy that anyone even tries. Anyways, here's the thing. While a person who is just a regular sort of W-2 wage employee has very limited tax strategy advantages, there are some, but I do want to let you know that in order to classify yourself and create a corporation like an LLC, it's extremely easy. Like, really, don't worry, it's extremely easy. As I alluded to earlier, like most things in the US, all great things, all amazing advantages that you could possibly have are hidden behind a small wall of information. And yes, it is small, but because people are not used to, reading these sort of texts, and I'm not either, although we do have ChatGPT now, which is really, really nice, but it can be very, very intimidating. You just feel like, oh shit, like what the hell I'm not doing all that. All right, I'll just continue to do what I know over here. Working for a wage is so much easier. We'll do that. So most people stop at the first sign of an impediment and honestly are doomed, and these people are doomed and cannot be helped because we have so many resources today. And, honestly, I don't have that much sympathy for people who don't at least try past that first level. Because, I mean, at the end of the day, it's like, do you need your hand held for everything? I mean, in a way, this shit should be taught in schools, in my opinion. But at the same time, it's like, look, it is there for you. It's just, it's hidden behind, a few pages of text. In some cases, many more pages as well. But it is generally pretty easy. And all of this stuff now can be done extremely quickly within, I would say, less than maybe 15 minutes. And it can be done all online as well. So, of course, those who recognize that this wall, that is indeed present, but it is very short, realize that they can just jump over the wall, reap the rewards, and it is, then it is yours. So in this case, it really doesn't take more than a few $100 in most cases, some cases even less, and a couple of online forms to incorporate an LLC. All of this, like I said, can be done online in many jurisdictions, and again, that's for you to Google. It's very, very simple to do. I'm sure if you just type in on Google, hey, how to start an LLC online, you'll get met with all kinds of options. In fact, I know for sure that you can do this because that's exactly what I've done in the past as well. But yeah, I'd even just have a very, very quick, sort of synopsis right here. I mean, this is quite literally it. Steps to form an LLC. First, you need to find a name, and that's a hard part. And by the way, you need to come up with a couple of other names as well, just in case if your ideal one is taken. Appoint a registered agent. Typically, you will find a company that is going to be like an incorporation company, and they will handle this. They will do this for you. You don't need to actually find someone to be your registered agent. They just appoint it for you. That person is basically a legal person who's there to satisfy this, this requirement. Then you file your articles of organization. That's done by, again, the whatever, online company you decide to go with. Again, very simple. You just input a few things. Doesn't take more than 15, 20 minutes. Maybe an hour if you really just want to research everything. That's fine. At that point, they're going to prepare an operating agreement. Again, you don't even necessarily do that yourself. They submit that, and then within a few days, maybe it takes a week or two, depending upon your jurisdiction, you get an EIN. That's your tax identification for the IRS, and then your LLC is formed. Beautiful. Very, very simple. Very, very quickly. Very, very quick in many jurisdictions. I'm not going to recommend any particular ones right here, but I can tell you that one of the areas that I use, or actually the area that I use, is Wyoming, just because it's extremely convenient. Can be done all online. All right, so let's get into the actual tax strategies. And this first slide here is something that everyone can do, or at least something that everyone can do if you're a W-2 employee or if you actually own a business. And like we said, just creating a business, pretty damn simple. And by the way, I should explain, why a W-2 person might want to do this, because this is going to give you access to more benefits. And typically, you can, if you use your brain a little bit, you can figure out something to create an LLC for. Maybe you're a contractor, in which case this is just a no-brainer. Create an LLC, go even deeper than that as well. But even if you're a W-2 employee, maybe you create a company for a side hustle that you got going on. Maybe you create it to take income from your main job. There's a lot of ways that you can make this work. Again, that's where you can get a little bit creative. Research, use your tools like ChatGPT or Grok, whatever the hell you want to use. Maybe at this point, also consult a tax strategist, because they might be able to kind of guide you in the right way here. But it can be done quite easily. And again, the reason why we want to do this is because it gives us more and more benefits. And yes, you can do this as a W-2 employee. It's completely fine. Anyways, as I take a sip of this water, the first thing that we'll go over is retirement accounts. I think this is what probably most people are familiar with, but there are several things that you can do and compound on top of each other. And the way that it typically works is that the retirement account is effectively an account that you can use as an investment account. So you're able to invest this money, and the money that you put towards your investments reduces the overall taxable income that you will have on your, on your tax returns. So if you make, let's say, $50,000, and then you put in $5,000 to your health savings account, then now instead of having $50,000 of total taxable income, you now have $45,000 of total taxable income. So it reduces the base that the IRS can draw tax from. Okay, so again, this first one works for everyone who is self-employed or employed. That would be the Roth IRA. This one is actually going to be with after-tax contributions, so you are actually not going to be reducing your overall taxable income, but the benefit comes later, because when you because this is, again, an investment account, when you actually withdraw that money from your investments, aka you sell your investments to get liquid dollars, you will not owe tax on that money. And you might be asking yourself, okay, well, is that really going to make a humongous difference? Shouldn't I want the pre-tax benefit? Not necessarily. If you're younger, this will typically produce greater overall results when you do pull out that money from the markets, because, with compounding and everything, that tax burden that you would experience at the very end would theoretically be very, very large. And so if we don't have any tax at all, hey, fucking amazing, man. But yes, you will get taxed with the money that you put in there. So fair enough on this one. This one's a little bit of a different sort of beast here, but I did want to go over it first. I think a lot of people are familiar with this one. There are limits with this, of course. It changes every year, I suspect, but $7,000 for anyone under 50 and $8,000 if you're above 50. That's per year, so it's not a whole hell of a lot. But again, the major benefit here is that you get 100% no tax when withdrawn. Your contributions are basically made with post-tax dollars. But again, that is tremendous. It's a tremendous benefit. And we'll go over later, a sort of supercharged way to do this as well, and, basically just put more money in there. The second one would be a health savings account, HSA, and these contributions are with post-tax dollars, but this is actually the most tax-advantaged account because you're getting a tax advantage in three ways. One, the money that you contribute to this health saving account, which is an investment account, by the way. You are making investments with this account when you put money towards it. So again, that compounds over time. The money that you put in is going to reduce your overall total taxable income. So you're getting the benefit there. Then when you pull the money out, that money will not be taxed, and you're also getting tax-free growth. So you're getting it from three different angles. This technically has the most overall benefits, but the contribution limits here are going to be a little bit on the lower end. But here's also the thing. With a health savings account, you're getting health insurance. That's the premium that you're paying. So that money is, one, covering your health insurance. So it's helping you out in that way because, you might run into issues. Of course, these do happen naturally, and you're covered there. You don't have to worry about like a career ending or financially devastating event because, you went to the hospital and now you actually have health insurance. And then you're also investing that money so that over time, if you don't really have any health issues, or if you just decide to pay for that stuff out of pocket anyways, then guess what? You have a non-taxed health, or you have a non-taxed investment account that's just compounding money for you again and again and again over time. And again, the limits here are a little bit on the lower end. It's $4,300 if you're just doing self coverage. If you're doing family, somewhere around $8,550. Like I said, these will change over time. Probably goes up over time, to be fair. But yeah, again, the money that you contribute here, that reduces your overall taxable income. If you have $50,000, you contribute $4,300 or $5,000, whatever it is, then that reduces your overall taxable income to $45,000. Then also, if you are self-employed, or you have an LLC, an S corp, small businesses, sole proprietor, these sort of things, you could do something like a solo 401k. And by the way, you can also do just a regular sort of, I guess it's an employer-sponsored 401k. If you are just a W-2 employee and you don't want to go the company route, it'll work the same way basically, but this is going to be, again, a strategy where you are putting money in an investment account, and any money that you put in this investment account is going to reduce your overall total taxable income. And by the way, you can combine a health savings account with your 401k and a Roth IRA. You can do all of these things. So the 401k, that's going to reduce your total taxable income. Your health savings account will also do that as well. So let's say, you contribute $23,000 because this one does have higher limits. And by the way, your spouse can also use this as well, which will double that amount. Or I don't know if it necessarily doubles that amount. You might need to check that exact statement, but it'll add to that amount. It'll make it higher. Anyways, your contribution limit there is $23,000 or $43,000 if you are both employee and employer. That's when, having an LLC or an S corp or just some sort of a small business corporation really starts to add up, because then you are employee and employer. So you'd get $43,000, almost doubling that $23,000. But, again, if you have a regular W-2 job, then you'll have, I think the contribution limit is about $23,000 for that, for the equivalent 401k plan that you can have there. And again, that reduces your total overall taxable income. So in the example of you having $50,000 total income for the year, let's say you put $5,000 in your health savings account. Okay, that reduces it to $45,000, and then you put, through your job, $23,000 into your 401k. I don't necessarily know what the limits are, and I imagine it's different for different people depending upon how much you make. So again, just excuse the example. Just for math purposes, that's what we're doing this for. Then you'd have $45,000 minus $23,000. What is that? $22,000. Jeez, my brain's not working right now. And so now your taxable income is about $25,000. Or am I doing this right? Or something like this. Again, feel free to check me on this one, just because, didn't get the best night of sleep last night. It's always my excuse for this. But yes, sorry, it'd be 28. So yeah, you'd have $22,000 of taxable income in that example. $22,000 of taxable income. So you go from $50,000 down to $22,000. By the way, at $22,000, I believe you're at poverty level anyways. So your tax rate is going to go down to like next to nothing, if not nothing, something like this. So again, at that point, you're not even really paying taxes to begin with. Just again, like kind of a big deal. If you are self-employed and you have one of these structures through a corporation, you can do what's called a SEP IRA. That will actually give you a higher limit that you could put in. And again, this will actually reduce your taxable income. You can do up to 25% of compensation with a maximum of $69,000 in 2025. So again, you can stack all of these. You can stack all of these. in whichever way they are applicable to you. So just be aware of that. So yeah, you can already reduce it a lot, even if you are, just a W-2 wage employee, which is kind of like the worst case scenario, if you will. And like I said, regarding the prior slide right here, many W-2 employees, could start some sort of a side hustle, or maybe they could even start a corporation that they get paid to from their regular job. It's just the corporation getting paid now, but they're the single member in that corporation, blah, 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 blah. That can give them some tax advantages that they can apply over here. You might need to get a little bit creative with that. That's where I'd really say consulting with a professional will likely pay you in spades to figure that out, just to make sure everything's all legitimate with the IRS and under the and completely under the law. But yeah, usually they can figure out a way to do something like that. Anyways, let's go over some business owner advantages here, because business owners do get a lot of advantages, of course. These are strategies that only apply if you own a business or are self-employed. But as we went over earlier, you can be an employee, a W-2 employee. You can still create a business. You can still create a business, or you can create what's called a corporation. It's actually the proper term, that you do business from. Maybe it's a side hustle, maybe it's related to your regular job, but that can give you some of these avenues as well. So just because you're a W-2 does not mean that you can't use these. You just have to go through that one hoop. You just got to jump over that little wall that takes, probably less than 30 minutes for a new person to fill out online. Anyways, these are powerful because they don't just reduce taxes, they also increase how much income you can legally direct back into wealth building. And again, these ones over here are just building wealth for yourself to begin with, right? Like you're investing for your future, so you're not necessarily reliant or as reliant on the government for cash, later on. Anyways, the first one over here is going to be the S Corp salary plus distribution strategy. So an S Corp typically is going to be used for like a single member sort of corporation, or like a very, very small corporation. And what you're going to do here is you're actually going to be both a W-2 employee and you are going to be the owner as well. So you take income in two different buckets. You take one as salary, as W-2. So you will get a W-2 as an S Corp owner. And by the way, creating an S Corp, super fucking easy. By the way, all you need is an LLC. Then you just put in one fucking page to the IRS and voila, you can declare yourself as an S Corp. The biggest issue with this is just the waiting time. And then honestly, the biggest issue for me was finding a fucking printer to sign the papers in wet ink, is what they call it, because the IRS wants everything in wet ink. Don't ask me why. They're operating like fucking 30 years ago, apparently. But that was really difficult for me because I didn't have a fucking printer at the time. And, and printing these things out was a real hassle, to be honest. But yeah, so once you do that, you send in the forms and then you just wait for the IRS to say, hey, we got your forms, you're good to go. Anyways, yes, okay, so this is a salary and distribution strategy. Like I said, as an S Corp owner, you are going to bifurcate your income into two different buckets. One is your salary, which is going to come in the form of a W-2. The other bucket is going to be as distributions. And with your W-2 salary, that's where you get fucked the most, because you are going to pay payroll tax plus income tax. And so you're effectively paying self-employment tax plus your income tax on top of that. So you're paying your tax rate plus 15.3%, which is not great. Like obviously not great. But yeah, it should actually be tax rate equals 15.3%. That's your self-employment tax plus income tax. But here's the thing: you are allowed to split up your income into those two different buckets. And while the W-2 salary gets absolutely fucking shitted on by taxes, the distribution part of it has much more favorable tax rates. That's going to be somewhere around 20-ish%. Again, it depends on your situation. Maybe a little bit more, maybe a little bit less. Feel free to check that one for yourself, but it's going to be significantly less than the taxes that you would be paying on W-2, because you got to pay that self-employment. Plus, it's just it's the income tax rate, right? So with this, the biggest issue, or the sort of thing that people typically run into, is that you don't want to give yourself too low of a salary, because otherwise the IRS is like, hey, this is not like legit. And honestly, the biggest issue with the IRS is that they never give you like a straight fucking rule. They're just like, you should pay yourself a reasonable salary. That's their rule. It's like, okay, what's my reasonable salary? Like, it's hard to kind of figure out. You're supposed to base off of other people in your industry, but if you're kind of in like a weird industry, like I think many of us probably are, then it's like, I don't know what the fuck the normal one is. But basically, the more total income that you make in your company, the less percentage that you have to put in the W-2 salary and declare that. So, if you make $500,000, maybe like $90,000 to $100,000 as claiming as W-2 is fine, and then the rest, the next $400,000 you take as distributions, which have a significantly lower tax rate. So you're going to save a shit ton right there as well. Anyways, the next one would be a QBI deduction. This is up to 20% deduction on qualified business profits from pass-through entities. Again, your S corps, your partnerships, your sole proprietorships. This one actually don't have much experience with. And then, of course, the last one is actually hiring family. You could pay your spouse or children for legitimate work in your business. This is actually what my accountant does. It's really funny because when I was starting to work with him, he's like, okay, now you're going to talk with my daughter and my son about how to set up payroll and this and that. I'm like, oh, okay, you're doing all of this stuff yourself. But that, in my opinion, that's a great sign because he's practicing what he preaches. But basically, if you have your own corporation, you can hire your spouse, your wife or your husband, whatever the fuck you're doing, or them, they, whatever the hell it is, and also your children, and that moves the income that you're creating through your business from being taxed at your high bracket, which is going to be naturally higher than your kids, and pushes it into theirs, which is naturally going to be a lower tax bracket. So overall, that creates a nice saving for your family in general. If you're going to give your kids or your spouse like some sort of a like stipend, or maybe not as like some sort of compensation anyways for, again, legitimate work that they are doing, like Elsa does legitimate work in my business, they are going to, they should get paid, and naturally it's going to split that income up. So it's no longer going through your bucket, your taxes, it's going through theirs, and they're going to naturally have a lower tax rate just because, they're probably not going to be compensated as much as you. Anyways, and of course, that earned income allows them to open up a Roth IRA. Beautiful. I mean, you could even do a 401k for them as well, I would think. And by the way, before we move on, I do want to say that all of the strategies that we go over in this video, these are not exhaustive. I don't know all the fucking strategies. These are just the ones that make a lot of sense to me that I'm either doing myself or have looked at or are looking at for the future. So yeah, that is there for you as well. All right, moving on. There's something else that was on the top of my tongue that I wanted to say, but I completely forgot. Maybe it'll come back to me a little bit later. One moment. I never actually edit these videos. I do have an AI service that, puts in some graphics and shit like that, but I don't actually edit these videos from the time that I'm talking. So it's all off the top of the head. But then again, if I can't talk about something off the top of my head, I'm not good enough to fucking talk about it to begin with. All right, so the next big one, and honestly, this is among the biggest unlocks for reducing your tax liability. This is going to be real estate and hard asset depreciation. Now, this is actually going to go a couple levels deeper than what we're going to go over on this slide. So if you really know your shit, like, don't freak out. We will go over the big stuff that you're probably focused on. But yeah, first one's going to be real estate depreciation. And real estate depreciation, the IRS will let you treat your property as if it's wearing out over time. So it's losing value over time. Even if it's actually going up in value. So you buy a real estate for $1 million and, technically the appraised value might go up like $100,000, right? So you're kind of making money right there. But because technically your building is degrading over time, as things typically do, you can actually use that as a deduction. So I'll give an example right here. If your rental house, building only, not land, is worth $275,000, you can deduct about $10,000 a year in depreciation to offset your taxes. So again, that offsets your taxes like straight up. Very nice, very, very nice. But this is only going to be for that real estate. Now, again, like I said, in another slide, we're going to make this like infinitely more powerful, but need to lay the groundwork first. You can also do this with like business vehicles. I think a lot of people are familiar with this one. Cars above 6,000 pounds, the IRS will let you deduct part of its cost against your taxable income. You can use something called the actual expenses method, meaning that you deduct a percentage of your vehicle costs used for businesses, gas insurance, repairs, depreciation. But you really do need to use it for business. Like, this is where a lot of people run into trouble, and and this is where the IRS really will come after you in many cases, because people will, say that it's a business vehicle, but they're actually not using it for business. Like for me, I can't really do this myself because like I don't need a fucking car, really. I mean, there are ways that I could make it work, of course, but at the same time, it's not so easy for some cases. So really, you want to actually be this person. You could also do the standard mileage rate. It's not going to be a whole hell of a lot. And now I just remembered what I was going to mention earlier. So this is not necessarily like, I mean, it is tax saving, but I want to just go back here for a moment. Business owner advantages. And just in general, anytime that you have your own corporation, anytime that you are buying something for your business with the purpose of, using it in some portion of your business, in some part of your business, that is going to be recorded as an expense, which also offsets your taxable income. That's going to offset, your net profit, really. So let's say, you want to become a trader, for example. You want to become a trader. Fair enough. And by the way, I mean, this would be one way that many people could create their own corporation. Hey, I have a job over here. I work at 7-Eleven, but I also want to be a trader. So, I create my LLC or S corp, whatever it is. And then, well, I'm a trader and, I do all my stuff online. So guess what? I need a computer. I need a business computer. Well, if you go ahead and buy, a $5,000 computer, that $5,000 directly offsets your taxable income because it's now an expense. It's an expense, so it gets marked against your total income. And if you made $10,000, for example, and you spent $5,000 on your computer, congratulations, you have a net profit of $5,000, and the IRS can only tax you on that $5,000, not the $10,000 that you made. And again, this applies for all of the things that go into you making money. So that could be, your internet expenses. That could be, when you get paid out from your exchange, if you pay some sort of a fee, that could be deducted. Anything that really is somewhere in your whole vehicle of making money for your business, that can be used to offset your taxable income. That's my point, and I did kind of miss that. I wasn't really sure if I wanted to put in a slide. I feel like most people know this already, but then again, like I said, I didn't know most of the shit, and well, maybe no place is too low to start. Anyways, yes, let's move on now. So let's now get into the advanced real estate stuff. We have a nice picture of a very nice house here to indicate it's advanced. So real estate professional status. This is the big unlock with real estate. And this is like, I personally cannot, it's not that I can't understand, but I would not want to use real estate as like a wealth building activity. But for fuck's sake, man, real estate is a great way to reduce your tax liabilities. That's where I see the major advantage in here. And it is through this exact vein. This is not something that I've done specifically myself yet, but very likely we will do something like this in the future when it becomes relevant. So this is the real estate professional status. This is the big unlock. So if you qualify as a real estate professional in the eyes of the IRS, which is not hard to do, by the way, most spouses could do this, it's kind of like a side job. That means that you spend 750 hours a year on this, like doing real estate stuff, and more than 50% of your working hours in real estate activities. So you have to spend 75 hours a year working, and 50% of those need to be working hours in real estate activities. So that could be like, I don't know, you drive to your property and show it off, or whatever those real estate people do. I don't really know, to be honest. Then you qualify as a real estate professional. So it's pretty simple category to satisfy. And if you qualify as a real estate professional, then guess what? Your rental losses can offset ordinary income with no cap. And this ain't no cap in like the new vernacular of the youngins. This is meaning there is no top end limit. There is no cap on that you can use to offset ordinary income. So any losses, depreciation losses that you take get to go against your overall taxable income. Whereas over here, if you're not a real estate professional, then those losses or that depreciation can only be marked against like kind. It can only be marked against your real estate income, basically. But over here, now you can, if you qualify as this, now you can use that money to offset your overall taxable income. So the idea here of what most people do is like, or the classic example that my accountant gave me is like, I have my own business. My wife kind of works in my business, and then she qualifies as a real estate professional, and we are able to, we do our tax jointly, and we are able to effectively offset the income from my business, which is making like the actual money, with the real estate stuff that she's doing. And that just creates massive paper losses, which are, again, used to reduce the overall taxable income of all of the income, not just the real estate, but all of it. That's fucking big. So this is what many high earners do. They marry this with a spouse who qualifies as a real estate pro. Again, not difficult to do. And you can shelter huge amounts of active income. You can also do something called cost segregation and bonus depreciation. And this is effectively, with cost segregation, you accelerate depreciation. So that means that the depreciation costs that you are incurring upon yourself, you can accelerate that, creating massive paper losses in early years. So if you really need to reduce your overall taxable income, like in the short term, this is something that can be super useful for that. That means you won't be able to do it in the future, by the way. Like, there is a drawback with it as well. But if you have a big earning year right now and you just want to offset that a bit, yeah, you can take all those deductions now, and then you're fucked in the future. But yeah, if structured right, and you or your spouse qualify as a real estate professional, you can offset ordinary income, not just passive, but ordinary income, not just income from real estate activities, but literally all of your total income. So for example, you could buy like a $1 million rental property. It doesn't really matter how much it costs, but just for example's sake, $1 million, cost segregation, front loads $200,000 in year one depreciation. Guess what? If you qualify, that $200,000 in year one depreciation, which just front loaded a shit ton of depreciation, can reduce your overall taxable income in year one by $200,000. That's big. That's fucking big. Anyways, take another sip of this water over here. This video is maybe a little bit longer than what it should be, but I do apologize. There is a lot of stuff here. Okay, but we are getting near the end of it, though, I should say. Then there's also tax-efficient loss management. I think a lot of people are familiar with this, but this is really important, especially if you're an investor or a trader as well. But this is effectively tax loss harvesting. And the idea here is that you're going to sell your investments at a loss, specifically at a loss, to offset gains elsewhere. And this can only be done in like kind. So if you have capital gains through investments, then what you could do is you could sell some of your losing ones, as we went over in a prior video, which is, in my opinion, one of the most important lessons of long-term investing. Sell your losers at as big of a loss as you can to offset your winning capital gains that you have for that year, and then go buy more of your fucking winners, right? Now, in this example, we'll give an example right here. You got $10,000 in capital gains from selling stock A. Amazing. Then you have $7,000 in capital losses from selling stock B. Guess what? Now your net taxable gain is $3,000. But here's the thing. You actually can offset excess losses. So let's say you don't have any gains anywhere. Well, you can offset up to $3,000 of ordinary income each year. And by the way, unused losses do carry forward indefinitely, which is kind of nice, but it is a relatively lower amount, to be fair. So, up to $3,000 of excess losses can offset ordinary income each year. So if you just don't have any capital gains and you decide to realize a $3,000 loss, up to $3,000 loss, you can use that to offset your ordinary income. So bringing it down by another $3,000. Again, just go use that money to go buy some of your winners at that point. If it's losing that much, I mean, for fuck's sake, like, get rid of it. Or at least that's my opinion. You can do what the hell you want to do. Anyways, here's some advanced high income earner strategies. So these do require that you actually make a lot of money. And typically these come, I believe, in like an S corp format, but correct me if I'm wrong. That might not be exactly true. You might be able to do that in other structures as well. You take another sip of this water. Oh man, it's very much needed today. But yeah. Okay, so this first one is fucking absolutely massive, and probably the easiest big thing that you could do as a business owner. But it does require that you have consistent high income. So you must be a business owner with consistent high income. What defines consistent high income? Again, IRS does not really give a straight answer for this. I would imagine it probably has to be like maybe above $200,000 a year, but I don't really know, to be honest. But yeah, if you qualify, again, talk with your tax professional. If you qualify for this, this is the easiest thing to do outside of real estate. That is the biggest lever. Real estate, as we went over earlier, right here, this is going to have probably the biggest, potential effect. But this one's pretty fucking good too, and it's a little bit easier to do because it doesn't involve you having to buy real estate and manage that real estate, right? But yeah. This is the defined benefit plan, and this will directly offset taxable income by effectively just investing in shit, investing in stocks that you want. So again, directly offsets taxable income. That means that any dollar that you contribute to this investment plan, which is effectively a pension plan, to be honest, offsets your taxable income for that year. And you can put well into the six figures annually into this plan. Again, well into the six figures annually, which directly offsets your taxable income. So if you make $500,000 and you want to put $200,000 in this defined benefit plan for the year, well, guess what? Now you only have $300,000 in overall taxable income. It's going to reduce your tax liability by a significant amount. And shit, maybe even put in more. I mean, that's up to you. But yeah, like I said, this allows contributions well into the six figures annually. I don't even know if there's really a limit in it. And also my accountant really highlighted this one as I don't know why the fuck people don't know about this. But it's pretty simple to do. You just need to be a business owner. If you have an S corp, that's good. That's my structure right now. Consistent high income, and you want massive deductions. And then basically, you invest money into this plan, which is an employer-sponsored pension, but you're the employer, so you just do this for yourself. And I think you can do it for your family and spouse as well in your business or any employees in your business, perhaps. But again, that's not something that I'm completely sure of. But yeah, you invest money into that plan, and it directly offsets your overall taxable income. It's really that simple. And again, you're investing in shit. You're investing in shit. The catch is that it's not it's really intended for older people, to be honest. I think the term of investment is about 10 years that you can do it for. And then it turns into a pension, something like this. But again, it offsets your overall taxable income. It's a humongous lever. The next one is the mega backdoor Roth. Sounds like something that you might see on Pornhub, but it is actually a massively tax advantaged account in the same way that the Roth IRA account is. And again, that is not pre-tax advantages, meaning that money that you put into this investment account reduces your taxable income this year. It just means it doesn't get taxed later on. But this sort of thing will let you get up to $66,000 per year into a Roth account, which is pretty fucking good. Again, remember that money is going to compound in an investment account year after year after year, and then you don't pay tax at the end. So if you're making a shit ton of money, this is also a pretty damn good idea to save some money in the future. Because again, these are after-tax contributions. In a Roth IRA format. And then estate level, you could do stuff like trust, legacy planning. I don't have any experience in these myself, by the way, but that would be like GRATs, ILITs, family trusts. And this effectively allows you to transfer millions tax efficiently, because if you don't know, if you have a shit ton of money, or if you have really any money, and then you give it to whoever you want after you pass, well, they will actually have to pay a shit ton of tax on that, or at least a lot of tax on that, typically speaking. So you can transfer that money a lot more tax efficiently by using these structures here. I don't have any experience myself in these, but just wanted to throw it on there because it's something worth looking into if that's something that you're planning for. Which probably we should all plan for at some point, right? 100% success rate. We all die. Anyways, let's bring this one home and let's show how we can kind of layer these strategies for maximum benefits. Again, your foundation here, this is stuff that everyone can do. That's your retirement accounts. That's your 401k. That's your HSA, these sort of things. That's tax loss harvesting. You can do that as well. Again, with your investments. And then also kind of on that same list, but not technically on there, is recording things as expenses. So again, if you are an employee or an employer, especially if you have your own business, any sort of money that you spend in order to produce your business activities to essentially create more money, well, that gets to be recorded against your taxable income. So you get to reduce your taxable income in that way. And again, the Roth investment accounts, the Roth IRA investment accounts, These do not have a pre-tax benefit for this year. Your benefit is when you pull it out much later on. You don't get taxed on that money. Amazing. Then the next one, but maybe relevant to a little bit less people. But again, it's not hard to create a company and incorporate, is to be a business owner. And that allows you to do the S Corp strategy. That's where you, again, bifurcate your income into your W-2, which is higher tax rates. And then you can take the rest in distributions, which is significantly lower tax rate. You got the QBI deduction. You can hire family. These sort of strategies go there. Hard assets, again, real estate depreciation, business vehicle deduction, cost segregation. And this one's it should be in the green, but that would be real estate professional status. Big fucking lever mover right there, by the way. That's probably the biggest one, but it does require a few more hoops to jump through. And then advanced high income tools, defined benefit plan. That one's an amazing, especially even if you're like a single member, corporation. Really fucking nice. Mega backdoor Roth, trust and legacy planning. That would be the highest of the high and probably applicable to the least amount of people. Then again, hard assets kind of goes in there as well, I suppose. But yeah, there you go. And now let's connect the dots as to like why is this moral? At least why is my opinion moral? How can I explain that I believe that this is moral? And I will after this sip of water. So here's the thing. We'll go through it one by one. Your retirement accounts is your 401k, your IRAs, your Roths, even your defined benefit plans, and your health savings account. These aren't loopholes. They're encouragements for you to save for your future, so you don't become dependent on the fucking government assistance later. And guess what? Then you get to decide what investments your money go into. It's not just like you're paying taxes and you kind of get, some shitty payouts from your Social Security later on in your life, which is low anyways. No, now you're actually choosing where that money goes. You get to decide what I want to invest in, and you're likely going to reap a lot more rewards, by doing this than by waiting on the government later. And again, now you're not sucking on the government's tit. So you're reducing the burden on the state. Very nice. Very, very nice. The next one would be real estate depreciation and 1031 exchanges. So these rewards exist because when you invest in real estate, you're improving housing, maintaining infrastructure, and driving jobs in construction, property management, and lending. And honestly, I bought a house recently, and I will tell you this, the amount of people involved in building a house, maintaining that house, selling that house, doing all of like the mortgage stuff for that house, it's such a massive lever. Like I always was wondering, why does it feel like the US economy is just people buying and selling houses from each other? Well, it's because this is such a massive lever for getting so many portions of the economic system moving and money just going. Again, think about how many different jobs are associated with even just constructing a house. For fuck's sake, man, that's a lot of people. That's a lot of different, facets. For fuck's sake, it really is promoting a lot of growth in many different areas. And also now you are facilitating, or not facilitating, you are taking on the risk, the burden of that process of effectively promoting, houses being built, and more houses being built is going to do what? It's going to lower the overall price of real estate. One of the major issues right now why real estate is out of reach for so many people is because there's not enough. It's supply and demand, for fuck's sake. So the more people that get deductions for taking on this risk, which there's a lot of risk in real estate. That's why I don't really want to get into it myself, to be honest. But yeah, there's a lot of deductions there. It promotes that sort of activity, which ultimately benefits everyone at some level because, when real estate prices go down, more people can get into a home. And that is the easiest way to start, multi-generational wealth building, by actually buying a home. Not having that cost, not being a fucking renter all the time and just, pissing that money away. I know that there's some pushback on a statement like that, but again, just for argument's sake. Anyways, next thing, business deductions, section 179 vehicles, QBI deduction, hiring family, these sorts of things. The government wants small businesses to grow, employ others, and stimulate the economy, so they give you the tools to reinvest into your business with less tax drag. That means when you try to grow your business and make it bigger, better, stronger, making more money, hiring more people, doing more of this, spreading out that whole wealth, well, they are going to give you tax breaks for, again, doing that. They're going to try to help you in that way. That's how they try to help you, by, reducing your taxes, your tax burden. And then, of course, charitable contributions. We didn't really talk too much about this, but DAF, CRTs, you're incentivized to give money to nonprofits, universities, and foundations that support social good, reducing the burden on the state. So again, here you get to decide where you are putting that money in. This one doesn't necessarily directly come back to you. Yes, you kind of reduce your taxable income, blah, 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 blah. But ultimately, this one probably the least efficient out of all these, to be honest. And also just charities are notorious for not being efficient with their money to begin with, or in many cases, very fraudulent, not even giving the money to the causes that they purport to be giving it to, or very, very, very small amounts, so I'd say that's probably the worst one. But yeah, overall, the idea is the government is trying to promote and stimulate growth in certain sectors that they deem a priority, which typically is based off of the ability of that sector to produce more and more wealth for more and more people. And they do this by giving you tax incentives, amongst other things as well. So ultimately, when you really look into this and learn this and start to take these steps towards using these deductions and advantages, you are actually doing the right thing. You are actually doing the right thing. Again, this is not saying that doing anything illegal is the right thing or the good thing. No. Like, you actually have to work within the bounds of the law, but the bounds of the law in the U.S. are actually really fucking advantageous and in my opinion, quite reasonable. Maybe not perfect. Okay, nothing's fucking perfect, obviously, but it is quite reasonable and it makes a lot of sense. And and it is a beautiful thing when it works out perfectly. So that's where I'm gonna leave off on this video. Again, I hope that this was of some value to you. I'm gonna continue with this series. I understand that maybe this isn't for everyone on this channel. That's completely fine. But I've really enjoyed learning about it. And so I wanna spread this knowledge around because it would have been infinitely more powerful to me if I learned this, I mean, shit, even yesterday, no, of course, but, just earlier, even just a day before I did, it could have saved me a few more bucks, let alone, the last 20 years, right? So these things really, really compound over time, and they're all available for you. Again, check with your professional tax advisor, professional tax strategist, tax professional in general, and make sure, you can do these things, or at least how they can apply to you. And I'd really strongly suggest to not just go with a regular CPA. These people are just punching in numbers. They are not they're not bringing the right energy. I always wish my CPA would be like, hey, look, you could, have so many advantages over here. All you need to do is just set this up. It's like, no. You need to search out the right people. There are plenty of resources for that on the web, but if you can bring these sort of ideas to them, a lot of the time they will work with you in that regard. But understand that not all accountants are created equal. The overwhelming majority of them are completely fucking useless, in my humble opinion. But of the very highly useful ones, they are worth their weight in gold. And that's where I'll leave this one. As always, wish you the best. Take care, much love, and keep an eye out for more videos in this series if you are interested in these sort of topics.